Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, April 5th, 2023, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we have a few different topics that we want to cover today with you. The first up topic that we want to talk about is, where do our trade ideas come from? This is something we've never really approached on the show, and we kind of just want to talk you through what a day in kind of how we're researching trades kind of comes from and see where it goes. I wouldn't say either one of us has a very regimented process that we follow. We just have different kind of, I'll call them favorite fishing ponds that we might kind of go to see what's biting. Then Viper has been on fire with the 1% trades, completely kind of crushing me lately in participation. And he has two retrospections that we want to go over on AMC and TMC. So those are two trades that we previously went over the openings on a previous episode. I'll put a link above for you to hop back to that episode. But today we'll kind of go back and take a look at what went right, what went wrong, what would we do differently. But before we hop to this week's content, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, a few of the other Blockhead traders. You can also pick up an audio version of this episode wherever you get your favorite podcasts. And lastly, you can follow each and every one of my trades, the good, the bad, and the ugly at thetagang.com/sprocket888. But Viper, let's hop to the first content here for this week's episode, and it is, where do trade ideas come from? And this is something that, I've kind of pondered before I really got into trading. You hear of all these people, oh, I made this trade, I went to this, and I thought, man, there is, I don't know how many thousands of ticker symbols on the stock market, New York Stock Exchange, NASDAQ, combined, how many different tickers there are. Then you throw in futures and commodities and all that stuff. And I'm like, where do you actually go to even get this stuff? And when I was first getting started, there's all these different, guru books of this, that, and the other thing. And I'm like, surely this is not what everybody is doing. And I'm like, is there like some secret news feed that these guys watch? And spoiler alert, I don't know that any of that is really true. But as I got more and more exposed to it, I kind of just started finding, I don't know, for lack of a better term, an analogy here is my own little fishing hole. But I don't know. What about you? Where do you get your trade ideas? Is there any mystery around it for you? How did you arrive at where you go today?
There's definitely still mystery. But I've gone through different phases and different waves of sorting and sifting. And in previous episodes, we've talked about some screener criteria that I've used on my favorite screening website, FinViz. And I'll occasionally still do that. I feel like I was doing that a lot more when I still had PDT on my account and I could pattern day trade, because that was more, I was very focused obviously on swing trading, and it seemed easier to find a decent technical screener setup for some of those swing trades that I was looking for. But as time has gone on, and I imagine this will be the case for a lot of people, just things change. I mean, interests change, you learn, you adapt, you just constantly evolve. And so a couple of things I've noticed happen. One is what I've mentioned multiple times now on previous episodes, which is currently on pause, which was my MES futures options scalping strategy. And that is pretty straightforward. That is, it's one chart. It's the MES. And I just look at that and focus on that. And I really would like to get back to that, because honestly, that takes all screening out of the equation. It's just this one chart. This is the one thing you do. And especially if someone's not trading and they just want to learn, and try and see different, patterns or price action practice, certainly I would recommend picking an index and just focusing just on that and ignore the rest of the noise. But it's still, currently for these 1% trades, like you mentioned, I tried to get back into some fishing and not just focus on practicing that MES scalping strategy. And so for that, it really has come down to, just keeping a finger on the pulse, ear to the ground, that sort of thing. I'll see people talk about things on Twitter or, various things hit my news feed. It's probably more Twitter and in our Discord, the people that are active in our Discord. One of them, the one that has taught a lot of us a ton of stuff about price action and reading charts. He does a great job at just screening constantly. I don't know exactly what his setup criteria is as far as screener, but I know he's just constantly crawling charts and charting them, and maybe taking a trade. I'll take some liberties to guess to say maybe he takes a trade 3 out of every 10 charts that he charts. But he just crawls through and charts and posts it. And so that's kind of spoiling in the fact that, while we're not, sticking true to, or we are sticking true to what we say as far as not financial advice. Don't want to put any pressure on him if he sees this or anything like that. But it's a great little just tidbit. And so I feel like that's the important takeaway of what I've gathered over the years. Is it's not looking to somebody be like, hey, what should I trade? And then you see a chart and you're like, well, they charted it out, so I'm going to make it happen. It's not about that. It's just that tidbit of like, that's noise, good noise in the not quite echo chamber, but just on the radar. And then sometimes I'll look at the chart and, 9 times out of 10, I'll be like, oh, that's a cool chart. I learned something, but I'm not interested in trading that. And every now and then something comes up, and just what I've been practicing and, drilling and honing my particular interests to, every now and then a chart will come up and I'll be like, ooh, this fits, XYZ, something I'm excited about for how I like to attack a play. And then I'll take it. So it's really kind of, I wish it was more deterministic and repeatable, but it's for me, at least for now, it's really come down to a lot of that, water cooler talk, I guess, if you will.
Yeah, definitely. Actually, one of the things I would echo is your comment that you made there is pick a ticker, pick an index, learn it, trade it, like just hone in on it. I'll say there's a stable of those that I've kind of developed over the years. I think I can say years now. That there's just a couple of tickers that I love to trade. One of them is the Russell futures, the ES futures. I use the smaller one, MES, a little bit. Certain tech names, Apple, certain banking names, Citi. Yeah, there's just a few things where I'm like, okay, this is kind of a go-to thing. I like to trade it. And I consider that more of a stable or kind of status quo, where I don't really need to screen for it. I'm just waiting for it to hit my particular trade profile, my trade flavor, and then execute on it. So I do think that's actually a good call out. Whereas some of this, what are you screening for, is more for, in my mind, you could call it diversity, but I think for me, it's a little bit to keep me interested so I don't get bored. Because looking at, one ticker of MES, which you were saying that, you're looking at that can get boring. Okay. Yeah, great. But if you're looking for a particular setup and it's not there, you're just like, twiddling your thumbs.
Yeah. Which I would also point out, there's a danger in that as well. Not just, twiddling your thumbs, but you start to get impatient and then you force a trade to happen where you're like, you're twiddling your thumbs and then you fake yourself out of like, I think I saw what I was waiting for. And then you start to go down the rabbit hole of convincing yourself you saw what you were waiting for. And then you make a bad trade. And so there's definitely that negative side of that focus on a singular thing. But yeah, I mean, to what you said though, it depends. Like if you don't have a lot of time, it's really great to just focus on one chart and exactly like you said, wait for a particular setup, set alerts like Trading View. Well, I mean, I'm pretty sure everything will have a pretty robust alert system, but if I'm waiting for this price, I don't have a lot of time to do this. I really, whether it's certainly you have a full-time day job, maybe even a busy season at that day job. Like I just can't even watch the chart. Here's the setup I'm looking for. Set a price alert. So that way, okay, I'm at work. I'm in the middle of something. I get the price alert. And I can't do anything about it. But now I know, okay, tonight, let me go look and see if the setup is still there. Put an order in, whatever. Anything like that to keep that idle time productive and not self-sabotaging.
I guess one thing that I found when I was really kind of new to the whole, trading stocks scene several years ago was there's a whole bunch of lingo. There's a whole bunch of industries. There's a whole bunch of stuff where you're like, what the heck is going on? What does high rates mean for that? What do they care about rates? Or, oh, high rates is impact to tech. Why the heck does tech care about interest rates? Or just the macroeconomic intricacies and interdependencies. And I guess I'll go through a little bit of what I call almost my daily routine, for lack of a better term, but it's kind of just how I ingest macro information. And that's the first thing I do pretty regularly is when I get up in the morning and I'm having my cup of coffee, I flip on CNBC. Okay, mainstream media news, they're always shilling some angle, always hyping something. Like I'm not listening to this going, oh my gosh, CNBC said this. Oh, this is the way that it's going. It's more of there's a lot of people that view it. There's a lot of people that take reactions from it. They're just reporting what actions are happening out there. And one of the things that I always thought was I thought trading was much more mysterious, much more know-how, much more technical oriented. And when you really get into it, it's pretty fascinating because yes, there are technical aspects. Yes, there are financial angles, but one of the largest factors is just human behavior and human emotion, which is pretty interesting to kind of see that play out. And for me, turning on Squawk Box happens to be the show that's on there. It's usually 6 a.m. is when I'm kind of kicking on that stream, and I listen to it for maybe about 30 minutes in the background while I'm kind of drinking my coffee, checking some emails, looking at some tickers, stuff like that. And all I'm really listening for is what's the big headlines? What are people talking about? Is there a war going on? Is there, pressure in commodities? Is there interest rate craziness? Are there banks collapsing? Just what's the big headline news? What's the consensus on what the Fed is going to do? And I don't really take any of that as, oh, this is what I think is going to happen now. It's just a data point that kind of feeds into it. The next thing that I kind of do as part of this morning routine, and often at the same time, is I'll pull up my mobile phone and I'll read the Wall Street Journal. So I will say that is probably one of the most value add kind of subscriptions that I've gone with. I'm not shilling it here. I don't get any credit or anything from that. But as far as a broad tool to cover what's happening in the economy, in financial news, basically it's news with a financial twist. A lot of stuff I pick up from the Wall Street Journal, and a lot of the early stuff that I started reading in there really helped me understand these interdependencies and the intricacies and stuff like that. And again, I take all this stuff with it's a data point. And if I find something in there that's super interesting, I might then open up a browser and start looking for other people's stories on a topic. Not usually. Usually I'm just looking for what's ticking the boxes as far as people going out there and wanting to chat about.
Yeah, that reminds me of a couple stories. And again, I don't necessarily condone any of this behavior, but we all have our story. We all have our path and our origin of how we got started and whatnot. Um, so way back when I first started trying to get more involved in trading, this was end of 2019, going into 2020, and one thing that what you said just reminded me of was way back. The very first thing I ever did was like just talking to a couple friends who also just started, and I viewed them as a little deeper than me. I mean, spoiler alert, they were, but not really. But they would mention, we'd text back and forth, and they would mention a couple tickers, and I would just dive straight into those tickers and maybe even buy 10 or 20 shares or whatever, and just see what happens. Um, but when I wanted to like start taking to a slightly next level, at least healthier in the degree of not just going and buying whatever a friend is talking about, um, I spent probably 2 or 3 months, like you just said, of I like to have noise on while I'm working. Sometimes it has to be music, but sometimes if it's a lighter day at work, it can be something a little more, interactive or pay attention to. And so for 2 or 3 months, I would just put CNBC on, like you said, in the background for most of the day, and just have it mostly as noise. But then, like you said, I would hear key things or you know themes that they were talking about, and then kind of rolling that around into 2020 as a more direct example of exactly what you were talking about. I still was doing that, and as the pandemic was unfolding, and I believe it was after we crashed, and then as we were coming back out, they started talking a ton about tech and just remote work, and Zoom was brought up a ton. And I mean, unfortunately, at the time, I was listening to it and I was like, oh yeah, Zoom, like, but you guys don't understand tech. You just hear people talk about Zoom. You use Zoom on your computer, so therefore you're on TV and you're just going to talk about it. I mean, suffice it to say, like, I literally can remember Zoom was trading at like $59 or $60 when they were talking about it. So yeah, maybe I wish I would have thrown a couple bucks at it then. But and so I ended up I didn't take any trades based on anything that they talked about then. But in hindsight, that's exactly what you're talking about as far as like just the fact that they were talking tech. Like I didn't have to jump into Zoom specifically just because they were talking about it, but tech and remote work and what was ahead for the months to come. That sort of theming made a ton of sense. That I wish I would have been maybe just slightly more proactive on, but I was in such early stages of learning. So the first trades I started to make, were just based on ideological passions. Like Beyond Meat was a huge one for me, where I was personally super excited about Beyond Meat. Like I've tried it, I tasted it, I liked it. It was all the rage, and so when it was like, oh, the IPO's coming out, like I wanted everything I could get of Beyond, and like that's part of what I don't necessarily condone or recommend. It happened to work out amazingly for me, but that still was a filtering criteria of like, hey, I really care about this. I'm excited about this, and it's also going to cross over into the stock market here. So I don't think it's bad per se, but definitely rewatch a lot of our previous episodes on risk mitigation and risk tolerance when doing stuff like that, getting into those passion parts of trading. But it's a start, and it's a screening criteria for sure.
Yeah, and when I talk about screening criteria, I guess I should almost call this activity I'm doing a pre-screener to the actual screener. So to me, I try to keep all of my trades anchored in very sound mechanics and sound fundamentals. When fundamentals, not in the terms of financial fundamentals, but fundamentals in the mechanics of what I like to trade. So for me, it's premium selling. You can watch pretty much any video on this topic of our channel here, and I probably talk about premium selling every single time. It's just that's my favorite type of trade, and there's rules that I have established with that. So my fishing for ideas is really not where do I go find the exact trade to make. It's what lake am I going to go looking in for throwing out a line, trying to fish something in. And because my trading style is very high volatility driven, I am looking for panic. I am looking for freak out. I am looking for abnormal sell-off. I am looking for oversold conditions. Basically, something that is just blown out of the water, because that is likely where there's, the baby has been thrown out with the bathwater. There is going to be other bargains in there. And I am just looking for what is that topic of conversation? What's that area of the market to go in? Like I said, there's thousands of tickers, so many areas to go to. So just what's my hint? Where's my clues? And so the topic that I'm listening for on CBC is almost never do I want to listen to one Joe Schmo talk. In fact, when it comes to Squawk Box, that's usually the part that I hate the most, is when they bring in some political guest or something like that. I'm like, okay, I'm done. I don't care about that. Whenever they bring in different analysts in there commenting, they always try to give a bull and a bear. In the lunch hour, sometimes I'll get what they call the halftime show. They have a panel of traders just kind of kicking off things. They change it almost every day. On my drive home, this is the other part of my day, I'll maybe catch about 30 minutes of closing bell. They'll also have another panel of traders. And all I'm listening for is, what are they talking about? What are they scared of? What are they, and it's just this meta theme. I then take that and then apply the rules and trading mechanics that I've kind of built up around to that area and say, what's there?
Yeah, I suppose I also, I kind of do the same sort of thing, just substitute, instead of CNBC, just various YouTube videos, various YouTube channels. My YouTube algorithm has gotten tuned pretty decently around some interesting financial YouTube channels, financial shows, trading shows, and they're usually pretty well produced, and so interesting to watch. And so I tend to find that I watch them for kind of the same things you're talking about here, where for every reason under the sun, we all know very well, the video headlines, there'll be super clickbaity, but as long as it's a channel I recognize, I'm like, no, you're not. You never actually have this clickbait take. You usually have a smarter take, broader take, and so kind of go into it and try to glean some of that broader take on it. Obviously bank panics and bank selling was a big thing recently, and so leading into that, there were a ton of those videos hitting my YouTube recommended feed. So I kind of have gotten some assists from the algorithms there.
Yeah, and there's a social aspect to the stuff that I do. One of the other things that I've kind of been working on, over time is the Twitter. Yeah, okay, everybody maybe is fleeing from Twitter these days because it's being wrecked, or I don't know where your views are on that. But guess what? There's still people that post stuff on there, and if you start kind of finding the people that trade like you, or that you've heard about or found, you follow them. And who do they follow? What do those tweets look like? Maybe follow them. And so there is a core bit of Twitter people that are like me. At least I think they're like me. They're not don't seem to be big accounts. They've, gotten together in various events, around the world just to meet up and say, oh, hey, we like to sell premium selling too. And I kind of scroll through the Twitter feed to see what are they tweeting about, because they'll tweet out, hey, have you seen the IV on blah, 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 blah? I'll be like, oh, wow, they're looking at what is, oh, yeah, that's nice. And so I think it's just a collection of our Discord has actually been coming. I don't want to, I'm not shilling our Discord, although it's pretty cool. There's trade ideas that come out in there because once you kind of figure out what traders in our Discord trade what types of styles, they might make a comment like, oh, I found this, or, oh, at Sprocket, this is your type of thing, right? Have you seen? And I'll be like, oh, wow, that's nice. And yeah, that's just another aspect of it, is just find those pockets of people that I guess what I want to call out is it's all anchored in real trade mechanics. Don't think that this kind of pre-screener really substitutes for your own style, your own flavor. But the world is a huge world. So if you like to look at a particular type of scenery, you just want to know where is that, the fall colors in the United States, right? When are the fall colors at their peak color in what region, right? Then you go there to that region. Yeah. The market is the same way. There's going to be different sectors of the market that are going to meet your trading flavor at different times in the economic cycle. And so it's just figuring out, where are your type of fish that you like to go for biting and what pond are they in, and going to that pond.
And for anybody watching this that's like trying to get started or is still in the early stages, I mean, this is kind of like step 2 or 3 of the process, because like Sprocket just mentioned, when you have your style, when you know what you like to trade, things like that, the beginning stages of just finding your style, and it's so much more important to focus on the different fundamental mechanics that pertain to a particular style, whether it's swing trading or options trading or things like that. There's a whole, I think, very fun period of learning just to learn the style. And so when you're doing that, like, you're not making trades, or if you're making trades, they better be paper account or heavily risk mitigated. And so you're not really that worried about screening criteria yet. You're trying to learn the mechanics and learn the machine. So if this, and I just say that because if this is at all overwhelming of like, there's so much I have to do, like, no, like, this is like, let this come to you. Let it come to you to be like, okay, I'm feeling pretty good. Like, now I want to know how to, let the path of learning lead you.
Yeah, definitely. The one thing I would put out there that I just found super helpful for me to get in the world of financial, like, what is all this stuff, is the Wall Street Journal. It is a relatively, for as much free media that's out there in the world, it is a relatively kind of expensive endeavor, I guess, to get the Wall Street Journal. Usually you can get your first year pretty cheap. But I will stand by a lot of the content that I read in there just to give me good foundational contextual knowledge in the world of financial news. They cover things a little bit outside of it, but they always cover it with a financial twist. It's a subscription I still keep today. I've had it for a very long time, and I see a lot of value in there. I will mention I did try the Financial Times for a period of time as well. I had read that, that's much better for financial coverage and stuff like that. And frankly, I was very underwhelmed by the type of content that was in the Financial Times for its cost. And I still really stand by the Wall Street Journal as a very good Swiss Army awareness of financial news. Viper, let's move over to the 1% trades. We got a 1% retrospective, and let me pull up the 1% chart that we've got running here. This is the Viper show, because I have not put a 1% trade on. I guess I really better get cracking on this to catch back up to you, because holy smokes, you're running away with it here. And this next kind of batters up. You've now put on 3 trades and you've won 3, and you've won pretty big on them as well. So the 2 there are the bottom 2 that we're going to talk about, the AMC and the TFC. But the AMC you basically held for about 7 days. You bought it on the 21st. You got rid of it on the 28th. You turned 100% profit. That was a $100 bet you put down. Then at the same time you opened that one, you opened a TFC trade. You closed that one out 1 day earlier than that. Turned around 97% profit, yielding $99. 6 days there, which basically brings your record 3-0 with a P&L on this round at 226 to my 0-0 record. With my kind of negative return from the first round of things. So you're clearly mopping the floor here, but talk me through some of these. Like, I think we want to look at maybe AMC first, but what did you learn from that? Take us through your retrospective.
Yeah. So it's been nice to have some wins on the book for sure. But they haven't, like, they're not like, I don't know. It's not like super confident wins. It's like, okay, so it worked, but I've taken so many lessons through these plays that, it's been okay. It worked, but, as we can see on the AMC chart here, it worked and I missed it by this much before it really would have not worked. Um, so, I'm trying to keep that in mind of, I don't want to say got lucky per se, but luck was definitely involved. But nonetheless, if we take a quick look here, I think we kind of talked about AMC a little bit, but big picture, the setup was, as we talk about the screening and stuff, AMC occasionally perks up on the news feeds, especially if GameStop comes up. I think there were GameStop earnings somewhere near when I opened, but honestly, the GameStop earnings might have tanked AMC here in the end. But nonetheless, it clearly is still living its memeiest life, where it does a spike, it comes down, it consolidates, it does a spike, et cetera, et cetera. And so I took this because it came up on the news feeds again, and Twitter was talking about AMC. So I was like, let me check in on that. And when I checked in on it, I saw a consolidation pattern down here, which was similar to this previous consolidation pattern here before it ripped and took off. So that combined with the risk-controlled aspect of buying calls or buying puts, buying options, it just seemed like a good opportunity to take a fairly low risk, or at least risk mitigated entry. And so, as you can see here, around this yellow circle is when I bought 4 contracts, 4 calls for the $5 strike, and this played out just beautifully. So, I mean, right after I bought them, we spiked, and this was one learning lesson where I don't know, and Sprocket and I have kind of talked about it, but it's, there's not a lot of forensics in retrospective, but something about this initial gap here was super juiced. And I don't think it was a pure bug because it lasted about 8 or 9, almost 10 minutes. I had the option that I probably could have gotten out, but this gap up here right after I bought these, like these got way juiced, and I think it was up to like 140%, something like that. And then after those 10 minutes, volatility or whatever was causing it, it crashed down, and the price of the options came back pretty close to my entry. And so that was one lesson of, like, the way I'm approaching these plays of buying options. Just the second I see that kind of volatility expansion, strike it, just go. That is the play. Don't lose sight of the play. It's not about, at least the way I'm using them, it's not about getting to $5. It's not about getting in the money or anything like that. It's about volatility expansion. And as soon as you get it, grab it. So obviously I didn't grab it there, and then we cooled off and we came right back down. But I didn't panic because, I was reading the chart and I was waiting for a much bigger day ahead. And then we started to get those and it just ripped. And then you can see up here, we got decently in the money here. The chart read itself also, I didn't actually chart it, but it was somewhere up here is a natural level to expect a reaction off of and not just go sailing through. So again, that's another important part of the due diligence here, is to have levels in mind of where reactions are going to happen, because I mean, you see these green candles and it's just going. And it is, if you did not prepare your strategy, it's so easy to see all this green and go, it's good, we're just going to keep going, this is what a rocket feels like. But that's not the case, as you can clearly see here. And so I stepped off right up here. It got up right up to this level. It started getting resistance. I wanted to hang on, and I wanted to be like, no, we're going 6, 7, $8. The Wall Street bets have gotten control. Like, it's just gonna go short, squeeze it. But that's all emotional talk. That was not part of the plan, and that should never be part of the plan to count on that, unless you're just straight up gambling on it. So I stepped off, and obviously the power of hindsight shows that was a fantastic decision, as we have now just completely dumped off the cliff here with a massive gap down, which would have, like, this sideways consolidation would have brought these profits down. I think I still would have been in profit, well, clearly, because I'm in the money here above $5. But this dump here just would have zapped it all. I didn't watch. I didn't look at the price of the options, but I can pretty well guarantee that kind of drop all the way below where I entered, I'd be looking at potentially, like, probably not a full loss, but we'd be looking 60, 70, 80% loss at this point on this one. So
Yeah, depending on your time to go, you're probably looking at pennies after something like that.
yeah. And this yellow line here is expiration for these contracts, which is tomorrow as of this recording, since I'm zoomed in on the 1 hour chart here. But
Yeah, actually, if we go back, I'll put a link above to the episode where we talked about AMC. Actually remember talking about your various option plays there, where I was like, "Oh, you're kind of just getting a little bit lucky on the one because you're buying some pretty high volatile names when you're kind of going into them." And we kind of had that conversation, and you started kind of throttling back your AMC, and I was like, no. I actually like your AMC trade because you're playing this volatility expansion, and AMC, was a much cleaner read on a volatility expansion play. And so I definitely remember kind of commenting on AMC as saying, "Hey, no, when you're buying options, this is where, from what I know of options, this would be the traits that you would want to look for, is that lower volatility on buying and that higher probability than for a volatility expansion, which is effectively the exact opposite that I look for. But like I said, that's the beauty of options, is you can actually both take completely different trades and you can still win both. And that is just cool.
yeah, definitely. And that it's going to come up on future episodes. I'm sure it comes up on this episode as well. Like, the fact that we're both exerting complete opposite option strategies, but one of our key setups is almost exactly the same, is still somewhat crazy to me. But yeah, the key thing in what you mentioned there, as far as where, and this was a big noted in my mind, as far as the potential for volatility expansion is kind of in this consolidation period down here. Yes, we had this dramatic crash down, but I mean, this is the 1 hour chart. This was several days worth of just complete sideways chop, slow creep. And this was the one thing where I was like, all right, I need to check the IV percentile a little bit closer. I don't know exactly what it was here, but I know it was lower because of all of this sideways chop here. So that certainly lent itself to more potential for volatility expansion. The one trade that had me much more concerned after we talked was hopping over here to TFC. This one, if we zoom in a little bit, make it a little more readable. Again, the circle is where I entered. This one, the IV was up when I entered, and this one was much more concerning looking because it was so juicy looking from the selling side of things, because that IV percentile was up. And if we look, I mean, granted, this is the 15-minute chart, but these are still daily gaps. And there's, we just saw on AMC, you had that nice consolidation period. This is whitewater rafting. This is gapping down. It's gapping up. It's going down. It's gapping up. I mean, it gapped up when I bought. And so this one, there was a lot more lessons learned as far as not jumping in so quickly, because I do believe IV percentile was probably 60, 70%, at least when I got in here. It might have been pushing the 80s. But nonetheless, this was also an example of me seeing the same exact thing you wanted to see, which was the panic being oversold. As we can see on this crash down here, that the price action was what caught my attention. And this was because I'm trying out this new strategy of buying options. Um, the price action is what caught my attention of like, this is so way oversold. And there's all these big gaps here. I won't go into all the price action analysis that I did on it, but I liked it as being oversold to buy calls then of catching some of that return, which makes sense in theory. But when you get into the Greeks and you get into the what make options tick, things started to fall apart on me after I've got in on the play. Those things being, yeah, okay, price might get back up there, but there's nothing that guarantees or says there's any reasonable expectation it's going to happen on a volatility expansion snap. It could take its time. It could trickle its way back up there. And so some of it was an emotional buy-in of this is a panic sector, therefore it's going to have an elastic panic snap recovery, which is not correct thinking to go into it. However, the one thing that kept me in the play, even though we had this nice pump here, it started to cooled way down again. I mean, it's a similar price action swing there of what we just saw on AMC. The one thing that kept me in the play was one, the fact that one reason I like buying options is I put the money down already. And therefore I already accepted my loss, potential loss of $100 up front. And I had my eyes on about 50 or 60% that I'd bail out, 50, 60% loss of that initial $100. So we never really breached into that bailout territory. Though I did because this was an experiment, because I did go for that smaller sized entry, I was okay just riding it out, to a complete $100 loss if needed. However, then we had, I don't remember what was the deal on this day, but we had a massive gap up. And this time I learned my lesson from the AMC action. We had this gap up and I anchored these purple lines to where I bought and where I sold. So we gapped up that morning. I checked. It was, what's the time on this? Yeah, 9:30. This was 9:40ish, I think, in the morning. Had the gap. I said, I'm out. That's good. That was good. I'll take, I was down about 20% at the worst here. And then all of a sudden I'm looking at positive 100%. Done. Let's get out. And again, with the power of hindsight, you can see we have not done that snap correction yet. It's certainly, like I said, price action says we're going to get back up there, but nothing says how fast it's going to happen, and that is a key distinction.
I don't know. I don't want to make frowny faces on this trade too much because it was a good trade. You had your price targets, you had your thing, you got home a winner. I guess the only thing I'll put out here is the caution in both the AMC case and this case. If you would have held on to that to where we are today, you would not be looking that pretty. Like I said, AMC, you definitely would be almost at zero. I don't know how much time would have been left in this one, but I'm assuming it's similar time frame as your AMC was. And when you are buying options, the clock is against you. And so your approach to get that volatility expansion, get that price change, cash out, that's the right approach. I guess my caution is to those people that are like, yeah, we're going to go in the money. We're going to get a big mooner. Like that's where buying options can get you into trouble because you have the ball. Your 24-second shot clock is ticking. And if you don't get down the court and put that shot up and put it through the net, you get a big nothing. And that's when people talk about risk in options, it's really how you define risk. So Viper says this is low risk because I know exactly my max loss. He's right if that's how he judges risk, right? And anyway, some people are like, well, risk is how much can I possibly lose? When you're buying options, your max loss is 100% of what you put in. Now, Viper knows that, and he was cool with his entry. So like that's why it was low risk to him, because he had acknowledged that risk. And so that's where position sizing comes in. I don't want to say this is bad because everybody has their own flavor. This is a perfectly valid flavor that you can trade, and it can work. It's just be aware of that stuff and what you like or don't like, and understand the mechanics so how's that clock running? What do I need to do?
Yeah. And I think that's important to continue to drill on, which is especially people new to options. I would almost say, and this is completely unscientific and completely unresearched, but I would bet buying options is one of the first things they do. And they probably do it because of the get rich quick stories, because of the Wall Street bets, because of the GameStop, because of the AMC, because they heard people say, I spent 25 cents on this ticket, and all of a sudden the thing went to the literal moon to $150, and all of a sudden I could cash out this for $20, $30, $40,000. And while technically that is a very exaggerated but true mechanic of buying calls or puts, buying options, I am definitely previously, currently, henceforth to the future, I am not interested in these things for that mechanic. I mean, forget the moonshot, but just as a vehicle to get a low cost entry on a particular stock, I'm exclusively interested in these because I'm fascinated by the way volatility expansion can happen so quickly and what it does to the price of that contract potentially so quickly. And I want to seize and capitalize on that. And the AMC case was a really good example, because flipping it back over there for a second, you can see I got in the money here. And I did the math and I didn't want it. Like, when I sold these, I'm in the money here, 520. And what is this? I had 4 contracts. So I had 400 shares, and I did the math on it. If I took assignment, like I could have pushed the button, I could have exercised those right there. I'd have 400 shares with 20 cents profit. It just, the math on it wasn't great, and I had no interest in that. But on the flip side, sell these things back, get these contracts out of here. And now I never had to worry about those shares. I just kind of synthetically, touched the value of them. That was much more enticing. And so, I think I'll probably bring it up again on future plays that I'm here because it's interesting to me that these things have this additional value attached to them, and the way market movements can blow that value up. That's just what I want to grab and move on with my life.
Yeah, where I think people get into trouble with options, because you're 100% right. The first thing people do on options is buy them. And I guarantee you, if you go read about somebody that says they've lost thousands of dollars in options, I guarantee you they were buying options. That's when people say they're so risky. I guarantee you they're talking about buying options, because you get what you tried here, right, with $100, and you're like, holy smokes, I got 100% profit. And so like, well, that worked before, that's going to work again. You know what? I'm going to put $1,000 down. Oh, wow, look at that. I turned $1,000 into $2,000. So you know what? Next time I'm going to put $2,000 down. And then that's where you get that position sizing gets out of there. Doesn't mean there's anything wrong with the trade mechanics, right? That's where your position sizing gets crazy. So when you lose 100%, then you're in a different bag. And be cognizant of that. And then the other thing you mentioned that I just have to put in this video, never exercise early. If you're an option holder, never exercise early. There pretty much is almost no benefit to ever exercising early, because that value is built into that option. The only time you might want to do that is for a dividend collection. But just, I'm going to throw that out there, because the value and the mechanics of that is that money of what that's worth is baked into where you sold it for. So you could, like you did, you sold them back, and all that intrinsic value recognized by that difference in price, you were rewarded for that but you never had to hold the shares.
Yeah. And
So I would.
just before I sold them, I had even texted you because this is where making sure when you go into something, like you have somebody you can consult, or, because something's going to come up that maybe you didn't prepare for. And while rectitude wasn't on the line here, like, we said, position sizing and all that, but still, I got in the money. And so the first retail thing you think of is like, "Ooh, I'm in the money. Like, it worked. It did the thing." And so I texted Sprocket and I was like, "Well, let me get this straight. If I exercise this, like, now I just basically bought these at $5." And, you're like, "Yep." And I was like, "Yeah, that doesn't sound great at all."
Yeah, and then I said, well, if you want to get rid of them, don't exercise them and sell your shares. Just sell the options back, and you'll get all that money plus whatever time premium is left.
Yeah. Plus the fact that if I exercised them, the account, the buying power hit of absorb. Like, I just bought 400 shares at $5. Like, that's what happens. And
you still have to pay for them.
Yeah. Huge headache. So yeah, just somebody else take this paper.
Well, Viper, kudos to you. Well done on those 2 trades. I gotta put my screeners all in action, because I better get on the board here with something. I guess even a L, I guess, can go on the board. I have had a couple of trades. They're on thetagang.com/sprocket888. You can check them out. They actually were winners. We've even done some shows. Unfortunately, they didn't fit the 1% criteria because they were just too juicy to take, and I couldn't squeeze them into a 1% trade. So I'm going to try to increase my due diligence to enter some 1% trades. Aside from that, that really brings us to the end of this week's episode. Hope you found some insight in how we look at the looking for trade ideas. Where do we look for? What do we kind of query? What are we reading? Viper and I both have our trading fundamentals or our trading mechanics that we're going after. So when we talk about looking for trades, what we're really saying is these are the ponds that we're going to go fishing in, the corners of the lake that the particular fish we like to try to go for are biting at. It's not really kind of looking for that. This is exactly where I find what I'm going to trade. There's a second level of what I would call more technical analysis of what meets our trade criteria, but it's more, where do you start looking? That hopefully you got some insight from it. Again, we had 2 more great 1% trades. Whether or not they were winners or losers, this retrospective kind of goes back to just talk about what went right, what went wrong. I think you definitely got some viewpoints from Viper as far as, okay, this happened to work out for me, but here's a cautionary tale. If I had done this just a little bit longer, this would not have worked out. So know your exit plan, know where you're getting off the bus, and even if it looks like the bus is going to skip all property, go straight to pass go and collect $200, you might not. So stick to that plan and go with the plan. Other than that, we got a holiday break this weekend. Of course, by the time this comes out, we'll have already passed. But more data, more market stuff out there. It's a continuous, ever churning cycle of news and attention jumping to the next thing. So good luck out there. Hopefully you can find something that interests you, a flavor you like to trade, and find something to execute, whether or not it be a paper account or a live trading account. So good luck, and remember, think outside the block.